back to Biz Talk TV. I'm your business guide, Michael Rager. Hey, we're getting ready to get to the time of the year when everything as business owners we don't like to do. We got to get ready for tax season, and one of the most important things we've got to do is categorize our expenses so we can take the most effective tax breaks that are possible. So my good friend Kristin Gunderson from Gunderson Bookkeeping, she's going to show us the best way to do that. Take it away, Kristin.
Hey, thank you so much for having me on the Biz Talk Show today. I am Kristin Gunderson, the CEO of Gunderson's Bookkeeping, and I'm here to get all of your bookkeeping and tax questions answered. So the question that came in today was, how do you categorize your expenses and what does that even look like? So one thing you got to remember is there's a thing called credits and there's a thing called debits, and your credits have to offset your debits and they need to tie each other. So a credit is when money is coming into your business, normally from the sale of product or services from your clients or your customers. So a debit is the opposite, is when money is leaving your business to be able to pay for things, to be able to operate your business. Normally you are paying your vendors for items. So that's kind of the difference between credits and debits. So now the thing that we need to get into is kind of like the big, large categories. So I'm going to go through those next. So the first item that will actually be found on your balance sheet, we'll talk about the balance sheet first, is there's assets, there's liabilities, and there's equity. And I'm going to explain what each one is so that you have an idea of what they are. So first is assets. Assets are anything that your company owns. It could be your petty cash account, the bank account, a savings account. It could be inventory that your company has on hand that they want to be able to sell. It could be equipment like fixed assets. All those things are assets to your company. So it's what your company actually has that's tangible. It could be things that are intangible also, and that would be like intellectual property, and that's kind of harder to put a value on it, but that would also be considered an asset. So the next thing on the balance sheet is liabilities. What the heck are liabilities? This is anything that your company owes people. So like say you take out a loan from the bank and you have to pay it back, that is considered a liability. Accounts payable is probably the most popular liability, and that is when your vendors have done work for you already, but they don't expect you to pay it for net 30 or net 60 days out from when they actually did the services for you. So accounts payable is also a liability. A liability could be your payroll taxes that you have to pay, your sales taxes that you have to pay. It could be, say you went and go buy a vehicle, you're going to have to pay back that vehicle, that is also a liability. Or say you have to get a notes payable from the bank, or even like an SBA loan, or notes payable from the owner itself. Those are all considered liabilities. And liabilities is kind of broken up in between short-term and long-term liabilities. So anything under 1 year is considered a short-term liability, and anything over 1 year that's going to take to pay it back is considered a long-term liability. All right, so the next item that we have left on the balance sheet is equity. And a lot of people don't understand what equity is, but equity essentially starts from if there's any money that was given out of the pockets of the owners and put into the business to get it going, that is equity. So say you want to start up a business and you put $5 grand into the bank account to get it going, that is equity in the business. And equity is kind of broken down into, there's capital, which is, again, what the business owner puts directly into the business to get it going. Then there is retained earnings. A lot of people ask, what the heck is retained earnings? And then there's dividends. Dividends are like, say you have a large company with a lot of shareholders, stockholders, and they're paying out dividends to them on a monthly, quarterly, yearly basis. That's where dividends go, and it doesn't really apply to small businesses. But retained earnings is something that calculates year after year. It's accumulative from when the business started. And so say you have a loss in your first year, and you have a loss in your second year, and then your third year you break even. Like, it keeps on adding up. So you have a loss and a loss, and then you break even, and then you have some net income, and your business is growing. So that retained earnings just is all your net losses or net profits from year after year after year into your business. And it's kind of, I always tell people, well, it's what your business is worth. It's kind of what you've done since you've opened up your business. All right, so that is everything that you're going to find on your balance sheet. And now we're going to go over your profit and loss. What are items on your profit and loss and how to get those categorized? So there's 3 main categories that you can find on your profit and loss. There's revenue, there's cost of goods sold, and then there's expenses. So revenue is anything that is coming into your business from the sale of your product or services. Your customers are paying you. That is all considered revenue going into your business. It's pretty important. You need to have revenue in order to keep your business alive and going. So the more revenue you have, obviously, the better things are going to go. Cost of goods sold. Cost of goods sold is anything that is directly related to the product or services that you're selling. So it could be material. Say you're selling houses. Well, it's going to be all the material to go into having that house be sold. So all the lumber, the plumbing, the electrical, even the labor for like your contract labor that you have to pay out. All that goes into a cost of goods sold category. And it's really important. And it's important if you're an LLC because your cost of goods sold, you get to take that off of your franchise tax report. So that's why it's important to differentiate cost of goods sold and just expenses. So what does an expense mean then? So an expense is every other item that you have to pay for in your business to keep the business operating. So expenses are like your advertising, your insurance, your payroll taxes, your bookkeeping, supplies, maybe software to run your business. Like all of those items would be considered an expense to be able to run your business. All right, so once you have like your cost of goods sold and your expenses broken down, basically it's called a chart of accounts in your bookkeeping software. And that's when you get to, when you're categorizing your items one by one by one, you want to have them broken down into correct categories so that you know how much money you're spending in a year on your advertising or your bookkeeping or your insurance. And you can make better business decisions by knowing those numbers. Like if your sales are going down, like you can run the profit and loss and be like, oh, my sales are going down. Maybe I need to start advertising more. I need to hire a salesperson, or maybe I just need to get out there and start doing some more sales. Or say you can take a look at that profit and loss and all your meals and entertainment are categorized correctly, and you look at that line item and you're like, I cannot believe I spent that much money on meals. Like, so now you know what, let's cut back on these meals. Maybe instead of taking clients out for lunch 5 days a week, we just take them out 2 or 3 days a week. But you will be able to make those better business decisions once everything is categorized. Another really important thing to know is there is a difference between just regular expenses and investments. So what are those investments? Investments are like your fixed assets. Your fixed assets that you get to depreciate over the lifespan of its useful life. So like 5 years or 7 years, sometimes it's 3 years, depending on what it is. Like a computer, I think is 5 years, even though it should probably be 3 years because that's about how long they last. But you get to depreciate those over the lifespan of their years. So my rule of thumb is any big piece of equipment like a computer or a cell phone, or maybe you're in construction, you need to buy like a backhoe or a pole hole driller. Anything that's over $500, we go ahead and we put it on the balance sheet as a fixed asset. Anything that's under $500, so say you need to buy a new monitor for your business, it's less than $500, so we're just going to take that one-time expense and put it onto your profit and loss, and that way we get to expense it in the first year that we buy it. So that's another thing to keep in mind. Any big purchase tickets items, like those are considered a fixed asset, so we get to depreciate them, whereas if it's a smaller item, less than $500, you can, if you want to use $1,000, you can use $1,000, but you get to expense it all that first year that you have it. All right, so that is kind of the bookkeeping tips for today on how to categorize all of your expenses and categorize everything correctly. I hope this was helpful. I know a lot of people don't like bookkeeping, but it is necessary for your business. If you have a business, like, you can't grow your business unless you have proper documentation and accounting to be able to know how your business is doing. That way you can make those better business decisions. So if you have any questions on anything that I talked about today or need help with any of that, feel free to reach out to us. You can find us on social media, LinkedIn, Instagram, and Facebook. We're at Gunderson's Bookkeeping. Or if you want to send us a text, that's probably the easiest way. You can just text HELP, like HELP, to 855-798-3350. Again, you can just text us at 855-798-3350, and we'll be able to reach back out to you. Thank you so much for having me on the Biz Talk today.
Well, thanks, Kristin. That was some great information. I know business owners they don't really like digging into the numbers like that, but it's something that we've got to understand and we've got to get great at.